It means that instead of the government printing up money and giving it to the big banks so that they could pay off depositors, which they couldn't do, they basically confiscated most of the deposits above the insured amount.
That's why a lot of people here, we think about gold as a hedge to currency devaluation, a lot of these problems. So how are you looking at gold at the moment, Doug? You have the benefit of many decades of experience to give us some perspective on gold's behavior and price at the moment. So do you feel that it's fairly priced, or is there another area that you're focusing your attention?
Well, I think it is fairly priced at 1,800, about where it is right now. And let me tell you why I say that. I started buying gold when it was just a bit more than $35 an ounce. This was back in 1970, 71. I read Harry Brown's book, fantastic book even today, You Can Profit from the Coming Devaluation. Book is 50 years old, but it's still an excellent explanation of the way the world works and all this type of thing. So ever since then, for saving, I've been buying gold coins. Ever since it was $35, a little over $35 an ounce. Okay. And so now it's $1,800 an ounce. And actually, it's treated me very well as a savings vehicle. However, I look at the price of gold right now at $1,800, and I compare it to the price of a house or, a suit of clothes or a meal at a nice restaurant, just normal stuff. And it seems to me that gold is in line, more or less, with everything else. Okay, so that said, I'm not interested in gold as a speculation. I'm still interested in it as a store of value, okay, as a savings vehicle. Periodically, though, it's a good speculation. And actually, what I really like are gold mining stocks, which happen to be right now. I think gold is going to go up. There's going to be another panic, a mania into gold where people pile into it out of fear and greed. That's going to happen again. But still, it's just reasonably priced now. It's not like anomalously cheap anymore. But I really like gold stocks right now. They are anomalously cheap in many, many ways, certainly relative to the major stock market. They are. So that's how I'd play gold if you want to speculate indirectly through the mining stocks.
It's interesting that you mentioned 1971 and investing in gold back then. So just a quick little kind of side tangent here. My grandmother recently gave me 2 $100 bills from 1971. And she had them saved. They're brand new all this time and gave them to me for this past Christmas. And I said, I took a real world exercise. I calculated the devaluation and I showed her how much that money would buy, how many groceries, let's say, that money would buy now versus what it would have then. And it's devalued something like, by the official, let's say, Canadian bank stats, something like 300%. So interestingly, I said, if you would have bought gold back then, it would have been worth, like you say, $1,800 at this point, but multiply that by the $200. So it was somewhere around, let's say, $5,000 that it would have appreciated to. And, for her to see the absolute difference in cash losing that value versus gold appreciating so much, it was a really interesting exercise, and being able to show her how that the devaluation of the dollars kind of really blew her mind. Go ahead.
And of course, the Canadian dollar, because these are Canadian hundreds, right? Yeah. And of course, the Canadian dollar back in those days, it might have been, $1.03 or $1.04 US or something like that, because it was at a premium. Now it's about 79 cents US. So that's in addition to everything else if you're Canadian.
Absolutely. Yeah. But interestingly, that kind of brings me to my next point, Doug, is that I want to get your idea of what the risk of holding cash is at the moment. One thing I've been wondering about is the risk of, let's say, bank bail-ins. Do you see that as a risk in a country that has bailed out banks in the past? and created trillions of dollars worth of currency to soften any blow that the financial institutions have seen?
Yeah, that's an interesting question. Because the first, well, maybe it's not the first, but it's certainly the one that I looked into most, this must have been about 5 or 6 years ago, where Cyprus, this was when Greece was in the news for being bankrupt, and Cyprus was like Greece on steroids. So I went to Cyprus to look at the economy and things on the ground and the stock market. And the Cypriot banks were bailed in. Now, what does that mean? It means that instead of the government printing up money and giving it to the big banks so that they could pay off depositors, which they couldn't do, they basically confiscated most of the deposits above the insured amount. What was the insured amount? Was it 100,000 euros? Something like that. And so people that had more than the insured amount in Cypriot banks basically lost most of what they had. And it's on the books now in the US, Canada, and a lot of countries that that's possible. And your savings, your checking account, your whatever you have at a bank, is just looked upon as another liability, like the bank's electricity bill or the bank's rent or whatever. Like it's just another liability. Mm-hmm. It's not like a sacrosanct deposit, which is what it should be. So that's entirely possible when these stupid banks, which have made all kinds of dumb loans in this bubble economy, go under. So I think it's foolish to have more than the insured amount in any financial institution. It'll be different this time. It'll be different. The government bailed out the banks the last time when it almost all went under. With who was it? It was Bear Stearns and all the rest of them. But this time it'll be a little bit different, especially since the average guy didn't get bailed out. It was the big institutions that got bailed out. I don't think they can do it politically or practically. So, listen, the whole world is on the razor's edge of. It looks normal just at the moment, mm-hmm. But wait a few months before this year's over. I think we're going to see real financial and economic chaos.
So, Doug, I want to get your take on the risk of inflation eroding the value of dollars as well. If the value of the dollar keeps falling in real terms as it is now, at what point does the population and by extension the rest of the world start to lose confidence in the dollar?
Well, that's an interesting question because the major export of the United States is the dollar. People think, well, what does the U.S. export in exchange for the Mercedes and the Sonys and cocaine and other good things that foreigners send us? Well, yeah, there's some Boeings and some IBMs and some wheat, but our major export to pay for these things is U.S. dollars. Mm-hmm. The trade deficit in the U.S. right now is about $1 trillion a year. Now, that means that, well, nobody knows. I haven't seen an accurate number, but there's probably something like 20 trillion US dollars that are floating around outside the US, and they're a debt, they're a liability. So if at some point foreigners who don't have to take US dollars any more than they have to take Zambian kwaches, actually, it's convenient to take dollars, but they don't have to. It's not the. So at some point when there's a panic and they all of a sudden start saying, God, this is a hot potato we're holding, the only place that you're certain to be able to trade those dollars in for real wealth is the US. So you could find trillions of US dollars being dumped into the US in exchange for real goods at any time. That could happen. And that would mean that retail price inflation in the US would explode overnight. It's a time bomb waiting to go off. Nobody talks about that, incidentally. And of course, if foreigners no longer want to take fiat dollars in exchange for real stuff, well, then how's the US going to import all that good stuff that it's now borrowing $1 trillion a year, in effect, to do. So that's in the cards also, incidentally.